our mission is to amplify the business voice to better align our systems to produce outcomes for students. So today we're here to talk about property taxes, but I just wanted to give you a little bit of a roadmap as to what we're going to cover. I'll start quickly with how schools are funded in Kansas. That provides, I think, the necessary context to set up today's larger conversation. I'll also walk you through the basics of property taxes. From there, we'll break down how Kansas and Missouri use property taxes to support education in their states. We'll also look at the tools states are using to provide relief and what's changed recently. Finally, we'll wrap up with trade-offs policymakers face when balancing property tax relief and school funding. So let's dive in. Starting with the basics, public schools are funded in three main sources. The federal government provides targeted funding, mostly through specific programs like Title I for low-income students and IDEA for special education students. The state then contributes the largest share, distributing funds based on formulas that aim to promote adequacy of education funding and equity of education funding. And finally, the local level, which is the main focus of our conversation today, which relies primarily on property tax revenues. Local revenue depends heavily on the wealth of a community, which can create some big differences in how much funding schools have when comparing across district lines. In most states, state and local funding together make up about 90% of the state or school revenue. So understanding local property taxes is key to understand school funding overall. Starting first, I want to share with you just the distribution of federal, state, and local across the states. And here we can see federal revenues. It's relatively small, between 5 to 10% with most states. It's been a little bit higher than that recently due to COVID era infusion of 190 billion in federal education dollars. But in normal years, it's about 5 to 10%. Kansas and Missouri fall right near the national average. These dollars are important, but again, they're targeted, mostly for things like Title I and special education, not general school operations in general. The state share usually makes up the largest portion of education funding in many states, but not all of them. Kansas is on the higher end, as you can see, with the state covering the majority of school funding, and Missouri is near at the bottom. State revenue only makes up about 30% of their K-12 education funding. That means Missouri relies much more heavily on local sources of revenue for education funding. And here's where we come in today, local revenue, which is primarily funded through property taxes. Missouri ranks among the highest in the country, with over 60% of its K-12 education funding coming from local sources. Kansas is much closer to the national average. Excuse me, I just got an interruption. Everybody still hear me?
We can still hear you.
Okay, great, thank you. So again, property taxes is central to how this funding is allocated among districts, and it's the focus of today's conversation. So now we've seen just how much schools rely on local funding, especially in Missouri. It's important to understand whether the money actually comes from, and that overwhelmingly comes from property taxes. But before we dive into the specifics of how Kansas and Missouri structure their school funding systems, I want to take a moment just to level set with you all on the basics. What are property taxes? How are they calculated, and who sets them? At their core, property taxes are imposed on the value of property, primarily land and buildings, and improvement to land and buildings. However, in some states, still tax other tangible property like cars, boats, mobile homes, goods that businesses hold for sale, and the machinery and equipment used in business operations. What property is subject to taxation varies widely in the United States. Most property taxes started as general property tax on all wealth at their conception in the early 1800s. Historically, wealth was held in tangible goods and assets, not in tangible versions of assets, so think modern stocks and bonds. However, over time, this has changed and the tax base is narrowed to primarily be focused on real estate holdings of individuals and businesses. Property taxes are some of the oldest form of taxation in all of human history, predating our sales and income taxes, which were not used widely until at least the last century. Now I want to quickly give you a breakdown on how property taxes are calculated, so stay with me. First, a local assessor estimates a fair market value of the property, what is known as the FMV. The FMV is based on the amount the property could sell for in an open market in an arm's length transaction. There are many ways to estimate the fair market value. But after this is estimated, the owner of that property is notified of that fair market value. Assuming the owner does not protest the fair market value, the assessed value of the property is then determined. The assessed value is the portion of the fair market value that is actually subject to taxation, found by taking the fair market value multiplied by what is known as an assessment ratio. Assessment ratio are set by state or local jurisdictions with some restrictions, but we're going to get to that in a little bit. The resulting assessed value is then multiplied by the actual tax rate or millage. Property tax rates are different than others, which are normally set on a simple percentage of a wage or a transaction. Instead, they are taxed according to a specified number of mills. Mills refer to $1 of taxes for every $1,000 every $1,000 in assessed value. So for instance, if you're assessed at $50,000 and the millage is 30 mills, your property tax bill would be $1,500 or $30 for every $1,000 of your property's assessed value. That's an awfully high tax bill, but we're applying mills to a property without applying an assessment ratio. The assessment ratio helps keep tax bills low by not subjecting the entire value of the property to taxation. So I just want to give you a hypothetical example here when we apply an assessment ratio. So you can see here the fair market value is determined at $100,000. We apply 11.5% assessment ratio, meaning that the assessed value of the property is $11,500 subject to taxation. So when we apply that 30 mills, then we get a $345 tax bill. There are many multiple districts that tax or subject properties to tax across the state. So comparing calculations in locations can be difficult. Tax analysts usually combine different mills subject to taxation in different properties to find an effective property tax rate to make it easier to understand in terms of a simple percentage. So who imposes property taxes? Well, historically, states did. But in the early 1800s to the early 1900s, that changed to be more local jurisdictions imposing property taxes. States differ in terms of what taxing authorities exist. And us in the Midwest actually have a unique number of given taxing authorities present compared to other states in the East and also in the West. Overall, we see in jurisdictions like counties, cities, school, special districts, libraries, and special taxing districts like fire protection, parks and rec, water and sewer services, all levying property taxes depending on the state we're talking about. In Kansas, the state levies a small portion of property tax alongside counties, municipalities, special districts, and of course, school districts. In Missouri, there is no statewide property taxes, but counties, municipalities, and school districts all levy property taxes. In addition, the state has libraries, fire protection districts, and other agencies and districts that all levy property taxes. But just for the conversation we're having today, we're going to be talking about specifically school districts that fund K-12 schools. Before we move on, it's important to know that states don't treat all property the same in property tax regimes. Both Kansas and Missouri divide property into types, like residential, agricultural, and commercial. And each class may be taxed differently, either by applying a different assessment ratio to a given property type, or by using a mill rate that's different altogether. In Kansas, for example, homes are assessed at 11.5% of their appraised value, while commercial property is assessed at 25%, and agricultural land is at 30%, but it's based on its income generating value, not the market price of the agricultural land. Missouri is similar, but it breaks real property into three subclasses, again, residential, agricultural, commercial. It uses a fixed assessment ratio of 19, 12, and 32% respectively. Each district then applies its own tax rate to that assessed value in Missouri. These classification systems are one way states try to tailor tax burdens to different property types, but they also can create inequities and complexities, especially when comparing across districts. Oops, excuse me. Before we move on, I'd just like you to all answer this quick question in the chat if you could. From the perspective of public finance, what revenue source is the most stable? I'll give you a second here. Yes, you are all catching on. It's obviously a leading question. The answer is property taxes. During economic downturns, most people lose income or reduce their spending, which means sales and income tax collections can drop quickly. But property tax collections tend to hold steady. That's because property values don't really fluctuate that dramatically in the short run, although we'll get to that in a little bit. That's a little bit different in the last 5 years. And delinquencies are usually much lower. Finally, I'd like to give you a sense of how property taxes fit in the overall state revenue system. Here, I will show you the amount each state generates in terms of property tax revenues compared to the total state's tax revenue collection. As of fiscal year 2022, property taxes made up about 27.4% nationally. While in Kansas, it's roughly 28.5% of the total state's tax revenue made up by property taxes. In Missouri, it's about 27.4. So about a quarter of all state taxes collected are property taxes. But looking at property taxes as a percentage of local revenues for school districts shows their importance in public education funding. Stability is part of the reason why property taxes have been long the backbone of local school funding. This chart shows here the local revenue for public schools that comes from property taxes based on the most recent national data from 2023. Across the US, about 64% of all local school revenues come from property taxes. Kansas is right in line nationally at about 65%. But I wanted to call your attention to Missouri, which really stands out with over 82% of local school revenues tied directly to property taxes. I also put on Texas to show another state that heavily relies on property taxes. In their case, though, not only is it a high percentage of local revenue, but it's a high percentage of overall public school revenues. Remember, Texas doesn't have any statewide income tax. The level of dependence has real policy implications. For one, in Missouri, even small changes to property tax policy, whether it's a relief program, a rollback, or a limit, can have an outsized impact on school funding. It's a reminder that while property tax relief can ease burden for homeowners, it also intersects directly with financial stability of school systems. And in states like Missouri, the intersection is especially sharp. Now that we've covered property taxes and how they work in general, I'd like to look at how they operate in practice, specifically in both states. While both states rely heavily on property taxes to fund education, they take very different approaches in how those taxes are structured, their limitations on property taxes, and how they're used to distribute funding across school districts. Starting first in Kansas, property taxes are a cornerstone of school funding, but they're integrated into a broader statewide formula designed to balance equity and local flexibility. For one thing, state law requires every district to levy a 20 mil property tax. So that's $20 per $1,000 of assessed value of a given property. This revenue is then collected and partially remitted to the state, where it's pooled into the state school district finance fund. It also helps pay for the base state amount of funding per student, which is determined by multiplying a district's weighted enrollment by a set base amount of funding. For fiscal year 2025, the 20 mil levy is expected to raise about $856 million, which covers roughly about 24% of the total needed for base amount of funding. The remaining $2.6 billion or so is made up with other state revenues like income and sales taxes. If the 20 mils generates less than expected, the legislature in Kansas chooses whether to backfill the difference or to reduce funding overall. To reduce the burden on homeowners, Kansas also exempts the first $75,000 of a home's appraised value from this levy. So if your home is worth $150,000, you're only taxed on half its value. On top of the 20 mil requirement, school districts can impose 3 other major levies. The first is the local option budget. All school districts must adopt their own local option budget, or LOB, that totals at least 15% of the total foundation aid, or the amount of funding required under the state's formula for the given district, with options to increase it up to 31.5% of the total foundation aid, which happens to be the statewide average, or 33% through a protest petition option. That depends on the district, though. The local option budget is based on a formula. It's funded through a combination of local property taxes and supplemental state aid. This supplemental state aid is equalized, meaning that poorer districts receive more help because they are property poor compared to property wealthy districts. For example, a district with $2.5 million local option budget and a $1.5 million state aid would have to levy local property taxes to raise $1 million. Districts may also levy up to 8 mils for a capital outlay levy for infrastructure and equipment needed like buses, roofing, HVAC systems, and other technology. And finally, bond and interest levy is a levy used to repay voter-approved bonds for long-term capital projects. So think new school buildings. While the 20 mil levy helps fund district operations, It's important to understand it covers less than 20% of total district spending. The state aid per pupil accounts for 40% of total spending, and the rest comes from other levies like the ones mentioned here, and there's also other smaller levies, and federal aid. This structure is designed to strike a balance, uniform funding through a base formula and local control through supplemental levies, with state equalization aid helping ensure fairness across communities with varying levels of property wealth. In Missouri, school districts rely heavily on local property taxes, as we've seen. Unlike Kansas, Missouri does not collect a statewide property tax, but local school districts are still expected to contribute toward education costs through locally imposed and voter approved taxes. Even the tax rates vary by district. The state's foundation formula assumes a uniform minimum tax rate of $3.43 per $100 of assessed value when calculating what it's called as a district's local effort. But instead of using a district's current property values, the state has actually frozen property values in the year 2004 when the state actually last updated its finance formula. The local effort is calculated based on what the district would have raised using that $3.43 mill rate applied to its 2004 property values. This assumed local effort is then subtracted from the total amount the district is entitled to under the foundation formula. The difference becomes the state's share of funding. The setup creates a few important challenges. For one, property wealthy districts may be able to raise substantially more than what the formula assumes, but they still get credited only for $3.43 based on their 2004 values. On the flip side, property poor districts may struggle to raise much locally, and as a result, these districts receive less state aid than they might if the formula used current day values for property valuations. The bottom line is, while the foundation formula guarantees a minimum level of funding, it still relies heavily on property wealth, which can lead to significant variation across dollars available for Missouri school districts. In addition, the current funding formula includes several modifiers that distort how accurately the state accounts for the actual amount of local revenue generated, or whether property poor districts are truly receiving the extra state aid they need. For example, a hold harmless provision means that some property poor districts with growing student populations receive less state aid than those with stagnant or declining enrollment, regardless of their property wealth. But that's a conversation for another day. So now that we've seen Kansas, Missouri, and how they use property taxes to fund their schools, it's easy to see why any changes to property taxes have big implications for education. And as home values rise, those implications are becoming harder to ignore. That's why many states, including Kansas and Missouri, are now turning their attention to property tax relief. So let's take a look at what that looks like and tools policymakers are using to respond. I assume you all know that since the beginning of the COVID-19 pandemic, property values have grown significantly. In fact, since 2020, property values have increased 27% faster than the rate of inflation, according to this chart from the Tax Foundation. And here's where things stand now. They're a little bit lower than where things were a few years ago, but we still have an elevated median price houses sold nationally. As of Q1 of 2025, that price stands at $416,000. Property tax relief has emerged as a top-tier issue in state legislatures across the country, and both Kansas and Missouri are part of this trend. In a previous role, I helped author the 2024 National Conference of State Legislatures State Tax Actions Report, which found that nearly half of all states proposed or enacted new property tax relief measures last year. And certainly that trend has continued into this year. These efforts take many forms, and we'll discuss them all later, but all aim to respond to a common challenge, a growing disconnect between skyrocketing property values and household incomes. This mismatch has spurred new conversations about fairness, transparency, and the sustainability of our local tax systems. And today, our discussion is part of a bigger movement, one that recognizes that tax systems need to evolve alongside evolving housing markets and local funding needs. This has led states to consider either direct relief programs as well as structural limits on property taxes. So let's look at both of those things. But first, I just want to show you what Kansas and Missouri are doing legislatively up until this point. In Kansas, lawmakers have took notable steps in 2024 and 25. First, they expanded the exemption of the 20 mills statewide school levy, like I said, from $40,000 to $75,000 in property's appraised value. That change provides modest relief and was a bipartisan feature of the final tax package passed last special session in Kansas. Second, they also eliminated this year a small 1.5 mil levy on property taxes used to fund state buildings at a state level, which is a sign of continued interest in reducing property tax burdens. Missouri has also passed legislation in 2023 that allows counties to freeze property taxes for seniors, and several counties have opted into this program. Then, during the most recent 2025 special session awaiting the governor's final sign-off, lawmakers have enacted a new property tax credit program. This credit would effectively cap a homeowner's property tax bill at their initial year of eligibility, with limited increases allowed annually. In some counties, that would mean up to 5% or inflation, whatever is greater. The program requires counties to place this up for a vote by the ballot of April 2026. I just want to caution, though, that being said, early legal analysis suggests that this provision may conflict with the Missouri Constitution. Whether or not the courts uphold it, it reflects the growing intensity around property tax policy, particularly for senior homeowners. As always, the intersection with school funding remains the central tension point. Before we talk about structural limits, it's worth taking a look at a few direct relief programs that many states offer. There are three common types of direct relief in property taxes. First is homestead exemptions, and we've mentioned this several times in Kansas, which reduce the taxable value of a home. So instead of paying taxes on the full appraised value, you're only taxed on a portion of it. So in Kansas, again, we increased the homestead exemption on this 20 mil school levy from $40,000 to $75,000 for all homeowners. Circuit breaker programs provide refunds or tax credits on individuals' income tax credits when a property tax bill becomes too high relative to their income. These are usually income-based and can help renters as well as homeowners. Kansas offers several versions, including the homestead refund or the property tax relief plan for seniors and disabled veterans. Missouri also has one. For instance, they have a property tax credit up to $1,100 for eligible seniors and disabled individuals. Tax deferral programs are the third primary way of direct relief, which allow eligible homeowners to delay paying property taxes until they either sell the home or another specified date and time. These aren't really usually available in every state, but where they are, they can help people stay in their homes even as property taxes and tax bills rise. These programs are all about targeting relief to those most likely to feel the pinch of rising property tax bills, rather than applying a blanket limits to the whole system. In addition to or instead of direct relief, however, states also provide limitations on property taxes structurally through law. These are referred to as property tax limit policies, and they come most commonly in three varieties: assessment limits, levy limits, and rate limits. So let's take a look into all of them. Each one is designed to slow the growth of property taxes, but they do so in very different ways, and each comes with their own trade-offs. First, we have levy limits. These don't focus on your individual tax bill. Instead, they focus on the total amount of money a city or school district or a county can raise from property taxes in a given year. That amount is usually allowed to grow slowly based on inflation or population growth. The benefit of these policies is that they put a hard ceiling on how much local governments can collect in total, which can slow overall growth of taxes. The downside is that some homeowners can still see big increases in their tax bill if their home value rise faster than others in their area. It also means districts may struggle to fund growing service needs in high growth areas. Second are rate limits. These put a cap on the actual tax rate, or the millage, that can be charged. For example, a county might not be allowed to set a rate above 1.5% assessed value. In many states, going above that limit requires a vote of the people. The benefit is transparency. It's easy for people to understand and compare, and it prevents local leaders from increasing rates without any public input. The drawback is that even with a capped rate, people's tax bills can still go up if property values increase. And in some cases, local governments may turn to fees or other taxes to make up for lost revenue. Third, and most controversial, are assessment limits. These say your home's taxable value can't go up by more than a set percentage a year, say 3%, no matter how much its market value increases. The advantage is that they protect long-term homeowners, especially on fixed incomes, from being taxed out of their homes due to rising property values. They make your tax bill much more predictable. But the trade-offs are significant. Over time, two identical homes can have totally different tax bills just because one person bought the house 20 years ago and the other one moved in last year. This creates serious fairness issues. It also discourages people from moving, which can hurt the local housing market and limit supply of affordable homes. So, just in summary, levy limits control how much governments can collect, rate limits cap the tax rate, and assessment limits protect individual homeowners from large increases of their assessed value. Each type addresses different parts of the tax system, and they all come with trade-offs that policymakers must weigh carefully. The next three slides will give you a sense of where each limit is being currently used. Starting first with levy limits, 35 states plus DC currently have them in place. Next, we see that 34 states plus DC have rate limit policies. And finally, 19 states plus DC have assessment limits in place. So taking a look at what this actually looks like in both states, Missouri places several guardrails on how much property tax revenue local governments, as well as school districts, can collect. These rules are meant to ensure that local revenue doesn't grow faster than what voters have explicitly approved before. First, each school district has a tax rate ceiling with a maximum tax rate approved by voters. If a district wants to go above that amount, it has to go back to the ballot and ask for permission. Second, and more uniquely, Missouri has what's known as the Hancock Amendment, which is a constitutional provision passed in 1980. It limits how much revenue school districts can collect from existing properties year over year. Property values rise faster than inflation. The district must roll back its tax rate to avoid collecting more than what is allowed. That means homeowners might see tax rates go down, even if their home values go up. Finally, if school district wants to raise additional funds to keep up with inflation, growth, or facility needs, it has to go to the voters again. And many have. In fact, most districts in Missouri now collect more than the state's minimum expectation in property taxes, like we've covered before, thanks to repeated local elections. This system gives voters strong control over local taxes, but it makes long-term financial planning for school districts a little bit more complicated. Kansas doesn't have any constitutional limits on property taxes like some states, Missouri, for instance, does. But it has adopted a couple important measures aimed at slowing automatic tax increases and boosting the public accountability. The first I'd like to highlight is the revenue neutral rate law, which was enacted in 2021. Under this law, all local taxing entities, school districts included, must calculate a rate that would bring in the same revenue as the year before, even if property values have gone up. That's called the revenue neutral rate. If a school board or county commission wants to raise above that rate, they have to notify the taxpayers, hold a public hearing, and pass a resolution to do so. This is what's known as a truth in taxation process that adds transparency, but it doesn't actually limit what the rate can be. So increases are still possible. They're just more visible to the public. The second limit Kansas uses is tied to the school district's debt. If a district wants to issue bonds for capital projects like new school buildings or major renovations, it needs voter approval first, like in Missouri. The repayment comes from bond and interest levy on local property taxes. These tools don't freeze taxes, but they give voters more say in when and how property tax burdens grow, especially during periods of rising home values. And finally, as we wrap up today, property tax relief is a growing priority, and for a good reason. Rising home values have pushed tax bills higher, and for many homeowners, especially seniors and those on fixed incomes, they're feeling the squeeze. Relief programs like exemptions, credits, and caps can offer meaningful help. But here's the key challenge. Property taxes are the backbone of school funding in Kansas and Missouri. So when we reduce or limit them, there's a very real risk of reducing revenue for public education. That leaves policymakers with difficult trade-offs to consider. How much relief can we offer without undermining school quality? If the state wants to make districts whole, can it afford to backfill lost revenue? And for how long? Should relief be broad and universal or targeted to those most in need? These aren't easy questions, but they all point to the same reality. Every dollar taken out of local property tax base is a dollar that either needs to be replaced or lost entirely. Finding the right balance is hard work of tax policy and education finance. Since we just discussed the tension between property tax relief and school funding, I want to now shift to the design principles that can help policymakers find maybe a sustainable path forward. First, targeting matters. Not all relief needs to be across the board. Focus support on groups who need it most, like seniors, veterans, or low-income homeowners, so that it can reduce the overall cost of relief and maybe improve its impact. Second, it's essential to evaluate trade-offs upfront. If the proposed exemption or credit removes $100 million from the local tax base, can the state reliably replace funding each year and for how long? Third, we need to think carefully about the unintended consequences of our decisions. Some relief policies can widen gaps between wealthy and less wealthy districts, or undercut the consistent base that schools actually rely on. And finally, it's worth thinking about long-term predictability. Tax policy doesn't just affect the current tax year. It shapes district planning, hiring, and long-term capital investments over the long term. Any relief should be designed to hold up through good times and bad. The bottom line is sustainable relief is possible, but only if it's smart, focused, and grounded in reality. And with that, that's all we have for you today. Thank you for joining us. And please make sure to sign up for our newsletter if you want to learn about these issues and more related to education and workforce policy in Kansas and Missouri. And if you're in Kansas and would like to join us, we're going on tour. We'll be making 4 stops across Kansas as part of our Cradle to Career listening tour, hoping to get feedback on issues affecting your communities, systems, and institutions. But thanks again, and now it's time for your questions.